Everybody, it's David Lenevieux from Rockmore Wealth Management coming to you from beautiful Nanaimo, British Columbia. Today, I'm going to touch on one of the most popular and well-known retirement savings plans that exists in Canada, and that's the Registered Retirement Savings Plan, or RRSP. What makes it so popular? Well, very simply put, every dollar that you invest into an RSP gets deducted from your taxable income. Because honestly, who wants to give more money to the CRA than we absolutely have to? So what does that look like? Well, let's take a scenario where an individual earns $100,000 in a year and they decide to invest $10,000 into their RRSP. Instead of being taxed on $100,000 of their income, they will only be taxed on $90,000 of income, which provides a large tax benefit for that individual. Additionally to that, that $10,000 that they invested into the RSP, it grows 100% tax-free inside that account for as long as that money sits there. And that will allow that money to grow tax-deferred, which means it'll grow to a much larger amount long-term for when they go to pull it out in retirement. So how much can we invest into an RSP? Well, on a yearly basis, you're able to invest up to 18% of your yearly earned income, or a maximum of $27,230 for the year 2020. Now, that contribution room also accumulates over your lifetime. So if I was unable to maximize my contributions in previous years, not only can I put in the full 18% for this year, but I can also add up the previous year's missed contributions and add that to the total for any one year or any future year as it'll accumulate over time. Now, there's also some additional benefits that come with the RSP, and there's some government programs that are available that I'll just briefly touch on because they are much more intricate than what I'm going to discuss here today, and that's the topic for a future video. But there's a home buyers plan available for first-time home buyers. And what that simply means is if an individual wants to put a down payment on their first home, they can borrow against their RSP to help make that down payment. And there's another program called the Lifelong Learning Plan, which will allow an individual to borrow against their RSP and help pay for their education or retraining for another occupation. The final thing I'm going to touch on the benefits of RSPs is the ability to income split for retirement and over your lifetime. So why is income splitting such a benefit? Well, simply put, it's going to once again save you on tax and allow you to keep more of your hard-earned income as opposed to giving it to the CRA. So let's take a typical scenario where you have one spouse earning a larger income than the other spouse. So we'll pretend that the higher income earning spouse is earning $150,000 a year and the lower earning spouse is only earning $30,000 a year, or even nothing because they're staying at home to take care of the kids. Well, obviously, the spouse earning $150,000 a year is paying much more in taxes every year. And if each one of those spouses were maximizing their RSP contributions on a yearly basis, the higher earning spouse was going to have a much larger RSP account when they go to retire. And that's probably going to mean that they're also going to be taking a lot more out of that account, meaning they're going to pay a much higher tax than they should in retirement. So one of the planning opportunities that exists is not only can that higher earning income spouse contribute to his or her own RSP, but they can also contribute to what's called a spousal RSP. And that simply allows them to equalize their contributions over the course of their lifetime. Now, that higher income earning spouse will get the benefit of saving a much more tax because they're in a higher tax bracket while they're earning the money. But when they go to retire, as they allow the withdrawals from those RSPs, they'll each take the same amount in retirement, meaning that they're able to stick to lower tax brackets and pay less taxes over time. Now, you guys should be aware that there are a number of things from an RSP perspective when it comes to taking money out. And the first thing you need to be aware of is every dollar that you take outside of an RSP is 100% taxable. Additionally, if you need to take money out early from your RSP, you are going to be subject to a withholding tax. So if I needed to take out $5,000 from my RSP in any one year, the government's going to immediately withhold 10% of that money. If I needed to take out between $5,000 and $15,000, the government's going to withhold 20%. And if I needed to take out more than $15,000 in any one year, the government's going to immediately hold 30% of my money. Now, I may need to pay more or less tax on that money when it comes to be tax time the following year, but that's going to be totally dependent on my marginal tax bracket for that year. Additionally, if you withdraw money from your RSP, that contribution room is lost forever. I just can't simply put that money back in. That contribution room is lost. Another thing that you may want to be aware of is what happens to an RSP when somebody passes away. So thankfully, with a married couple, when the first spouse passes away, they do have the option to roll that RSP, if there's any money left in it, 100% tax-free to the remaining spouse. Now, the issue does come up is when the second spouse passes away, and if they have RSPs left, unfortunately, all of the RSPs that are left are put on their income tax return for that year. So take a scenario where you've accumulated $250,000, $500,000 of RSPs over the course of your lifetime, and you still have a significant amount of that left when the second spouse dies. Unfortunately, all that money that's left is going to be added to their final tax return. And as you will probably be well aware of, if you had over $250,000 of earnings in a year, well, you're going to be subject to the highest marginal tax rate in Canada, which is most likely over 50%. So that means that up to and over 50% of all that RSP money that's left is going to go to the CRA, and it's not going to go to your beneficiaries. So that's where it's really important that you guys do some good financial planning with your accountant and your financial planners to try to avoid and mitigate these situations. Now, what's my advice when it comes to an RSP? Well, this is very generalized information, but the more money you earn per year, the more likely I'm going to recommend that you take advantage of your RSPs. I will always recommend that you take advantage of contributing to your TFSAs as well, but the more money you earn, means the more money you can save by contributing to your RSPs. So typically I look at people that are making over $90,000 in a year. I'm typically going to recommend that they do take advantage of the RSPs. And even with people that earn over $50,000, there's probably an opportunity to make some RSP contributions. If you're earning less than $50,000 a year, or even if you're between the $50,000 and $90,000 range, I'm definitely going to recommend that you're taking advantage of your tax-free savings account maybe first as well. So the more money you earn, the more beneficial RSPs become for you. Now, every individual situation is unique, and you really do need to take the time to talk to your accountant, to talk to your financial planner to make sure you put the best plan in place. Guys, if you have very specific questions, please don't hesitate to reach out to us. We can always be contacted through our website, www.rockmorewealth.com. You'll find our email addresses and phone numbers on there. And if you guys have any comments, questions, or you want us to touch on a specific topic, please just leave a comment below the video. I look forward to speaking to you guys next week on another topic. And you guys out there, stay happy, stay healthy, and stay safe. We'll see you next week.